Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Monday, May the 22nd. The year is 2023. Let's talk trading. Feedback. These videos are for educational purposes only. Your results may differ from mine. So, when you heard the word feedback or read the word feedback, what did you think? Because if you play music, or if you've gone to a live show, sometimes you hear that screeching sound and you get that feed. It's called feedback. And what happens is that the microphone is picking up what's coming through the speakers, and it just keeps doing it over and over, and it creates something called feedback. But that's not the kind of feedback that we're talking about. You know, there's another type of feedback where you get called in the office at your job for your review, and you get feedback. They tell you, what you did right, what you did wrong, where you can improve, where you're excelling, etc. And that's more or less the kind of feedback that I want to go over. The thing is, with the market, the feedback you get is on your P&L statement. So you're looking at the chart and you want to do a trade, you want to make money. That's the result you want to produce. And how you produce that result, that's what makes the difference, right? It's not what you trade, it's how you trade it. But the thing is, when you're making your trades, you can't really affect the outcome. You can't make it go up if you want to go long. You can't make it go down if you're short. You just don't have enough buying power to do that. So what you do is you come up with a method, a scheme, a system that says, if this happens, then the chance of this happening is probably better than 50-50. Or if I keep, taking this type of trade, I probably have a positive expectancy over a bunch of trades. And that's really the game we're playing in trading. It's not just one trade. It's a series of many trades. And that's just something that a lot of traders forget. So the feedback is, if you take a trade and it goes against you, it's like, okay, it went against me. But that's just one trade. You take the same trade again, it goes for you. It's like, okay. And then so maybe after 10 trades, you see, am I better than 50%? And if you are, then you probably will continue. Then after 100 trades, you might go, am I better than 50%? And if you are, then you continue. But if you're not, that's when you might want to start looking at your method, and maybe you might want to make a minor adjustment, or maybe you might come to the conclusion this just doesn't work for you. So for example, we just had a 3-ball put in, and we just had a flip-flop box break. So had you taken that flip-flop box, I believe, let's see, 59, you would have been able to grab maybe a pip and a half if you were quick. And now that same flip-flop box is going to present an opportunity here. And we're going to get a new flip-flop box. And so I'm looking that price should probably come to the open of this candle, because that looks like a return bar to me. It's almost a 6-pip 1-minute bar. So we're looking for it to get to about 60 again. Now I know, because I've been trading on my charts, 57 is the top of the previous H4 candle, and I'd be looking for that breakout so you can see how many times it's broken out past that 57 mark. And we can switch over to the H4. So there's that top of that previous H4 candle. Rather the high, not the top. The top would be the open, which would be 56.6, and the high is 57.2. So right around 57 is where I've been going long. And if you go back to the 1 minute chart, and we'll put that cursor right about 57, you can see it. Now, I had just said that price was probably going to get back to that 60, and as you can see, it did it and then some. So there's a nice move, and if you look left, you can see it just about hit that 2-ball area and stopped. So had you taken the flip-flop box from before, or even if you took the last one, you'd be up 2.6 pips. So that would have been a nice trade. So that's just something that, or that H4 breakout is just a trade that I've been doing for a while. I like the statistics on it. I like the number of pips it usually pays off. And the nice thing about it is you don't really have to do much analyzing over the course. So, for example, I start trading somewhere between 4 and 5 o'clock my time, which would be 7, 8 o'clock East Coast time. So I'm looking at the H4 candle from a couple of hours that opened a couple of hours before I started right here. In fact, this is the one of the screens, or what my trading screen looks like, because I have the previous H4 and the previous daily. And you can see how those, taking the cross of the line with the candle color, how nicely it can pay off. It's not a difficult trade. And so I've got the smart range indicator right there. And if I do a, let's see, show high minus the previous high. So over the last 11, 12 bars, you can see it's been worth 2 pips or more. So it even had one green that was only worth, 2.8 pips. There's a 4.1, and the rest of them were pretty huge. So once again, just trading with candle color at the line can be profitable. Once again, these videos are for educational purposes only, and your results may differ from mine. So, this is the study, or this is the analysis right here. And so then the feedback would be, how well did I trade it? Now, of course, my trading, I'm not going to get these numbers on any one trade, most likely. But what might happen is over the course of the 4 hours or 5 hours that I trade, I might have multiple opportunities at the same level where I could actually rack up more pips than what the one single trade from that previous high to the current high would have provided. So once again, looking at that 57 level, you see price came right back, touched it, and bounced. Now, thing is, you had an opportunity to make almost somewhere between 6 and 7 pips. You took that trade. But if you didn't take those 6 or 7 pips, the market took it back. So there's some more feedback right there. It's like, well, maybe I should take, the 5 or 6 pips. Maybe I should look left and see where might price stop. Where did it have trouble before? And for those of you that like to play with the fib numbers, you can see right here, that was 23% bounce off the bottom. There's the 38, there's the 50. And we've got another flip-flop box. So, feedback. One of the things about feedback is at the end of the trading day, you might want to look at what your trades look like. Not in terms of profit and loss, but on the chart, you look at the entry, you look at your exit, you look at what you took, how much you made or lost, and then you look at the potential. And then you look to see, is there something you forgot to do? Is there something you did that possibly you shouldn't have? Were you too early on entry or exit? Or are you too late? Now, the too early, too late, that's based on your method, not what happened afterwards. So let's just say, for example, you exited at the 50 percentile line on this trade. You went from, say, 23 to 50. That was your plan. So you can't say, oh, well, I left 3 or 4 pips on the table. Maybe I should have. No, that's not how that works, because you followed your plan. And there's a danger, and you might want to try and start adjusting the plan. But if you're going to do that, then you need to run all the statistics again to see, how many times does it do a 50% retrace versus a 68% retrace? I think it's 68. I can't remember off the top of my head now. Where is that? 3 levels ZZ. No, it's 61, isn't it? Yeah, 61%. 61.8 to be precise. So make sure when you're working with feedback that you get feedback that's valuable and accurate versus something that's not really measurable. You want to take the opinion out. You want to make it as objective as possible. So, fellow traders, I hope that helped. Because that's the one thing about trading. Every trade, you're going to get some feedback. So make sure you're paying attention to what the feedback's telling you, because it's not what you trade, it's how you trade it. So go out there and drain the banks. And this is the Rumpled One, over and out.